All right, it is 8, it's top of the hour. Let's start. Good morning, all. Welcome back to those who attended the first session, and welcome all to the second session of the ASC 842 Lease webinar. We have the same team today for the presentation. I am Sailesh Babu, Cheryl Bayer, and Greg Fiedler are joining me. And before we start talking about leases, let me share some housekeeping items. Please submit any questions you have via the questions feature on the webinar control panel. We have a lot to cover in this session, so we may not be able to respond to your questions during the presentation. However, we will follow up after the webinar. The presentation slides can be downloaded from the handout section of the webinar control panel, in addition to other helpful materials. This session is eligible for CPE. For CPE credits, polling questions will launch throughout the webinar. These need to be answered in order to receive CPE credit for attending this presentation. Okay, those are the housekeeping items. So let's actually, before we look at today's agenda, here is a slide listing the items we covered during the first session. We covered some basic concepts of ASC 842. Also, the slide includes a link to the recording of the first session. So those who could not attend our first session, those who want to revisit and listen to the first session, the link is there to the recording. All right, let's see the agenda for today. We'll continue with the I guess concepts we covered during the first session. So we'll look at the process for the recognition and measurement of lease liabilities and right-of-use asset, subsequent accounting after adoption and implementation, the financial statement reporting and disclosure requirements, and then Sikich lessee ledger tool. Greg will demonstrate certain functionality of the lease lessee ledger tool throughout this presentation. So even before we talk about the first topic here, let me reiterate ASC 842 is a complex accounting standard. Our aim is to provide a very high level training, and we would cover many of the topics within the ASC 842, but more in a summary form. Also, since we have a lot to cover, we may only provide a summary of the information included in some of the slides. All right, so let's review the process for measuring of lease liability and right-of-use asset. First, we have to measure the lease liability for each lease component based on the payments not yet made and calculate the net present value of the lease liability using the appropriate discount rate. Right after we calculate the net present value of the lease liability, then we measure the right-of-use asset amount for each of those lease components. So to calculate the right-of-use asset amount, we'll start with the related lease liability. To that amount, we would add and subtract some lease-related items. We will see what those items are in the next couple of slides. All right, so this slide, let's look at what lease-related payments are used to determine lease classification and measure lease liability. I'll go in detail at least one side of this table. So for lease classification, all lease-related payments made before commencement of the lease and those payable after commencement are included, including fixed lease payments less lease incentives, if any, variable lease payments that depend on an index or rate, exercise price of purchase option if the lessee is reasonably certain to exercise the purchase option, payment for penalties to terminate lease if lease term reflects lessee exercising the option to terminate, fees paid by lessee to special purpose entities, SPEs, and the entire potential amount owed under residual value guarantee. So all of these factors are considered to determine lease classification, that is whether it is a finance lease or an operating lease. So now to look at the lease liability measurement. All of the items which are used in the lease classification are also included in the lease liability measurement. However, any payment made before lease commencement are not included, right? Any payments made because it's a lease liability it's already paid, then it's not a liability. Also, instead of including the entire potential amount owed under the residual value guarantee, which is the last item there, only amount that are probable of being owed under the residual value guarantee is included to calculate the lease liability. All right, so only two differences. One is the payments not yet made are only included, and then probable of being owed under residual value guarantee is included. All right, so once we calculate the lease liability, next is obviously the right of use asset. So let's look at what is included in the calculation of the right of use asset. We start with the initial lease liability amount. To that, we add any lease related payments made at or before lease commencement. We deduct any lease incentives received at or before lease commencement. And we add certain initial direct costs incurred by the lessee. Now, please note, the initial direct cost which can be included in the right of use asset is limited under ASC 842 compared to ASC 840, where some lease related costs could be capitalized under ASC 840. So again, additional information is included in the slide for your reference. Okay, let's look at some illustrations of the concepts we just covered. Greg?
All right, thanks, Silas. We are going to show you a few illustrations of the concepts throughout the training. And I did want to mention, though, that these illustrations don't focus on the fundamentals of the calculations, like calculating net present value or how to prepare a debt amortization schedule. I'm sure the audience is pretty familiar with those topics from other current accounting standards. So we're going to look at some of the nuances related to that for the new lease accounting standard. And first, we're going to pick up with an example that we started with in the first session, where we looked at lease classification. And if you recall, we entered the terms here and looked at the effect of the potential residual value guarantee and how that resulted in us classifying this as a finance lease. Again, if we remove this item, it changes our substantially all the fair value measure. But it does not affect our lease liability and right of use asset down here. In the illustration that we're providing now, Silas pointed out that the difference between classification and measurement is that for measurement, we only include the amount that is probable of being owed. So if we assumed that we thought $1,000 was probable of being owed, you could see that the schedule updated here to add in this additional payment column to include that $1,000 at the end of the lease term, which then also increased our lease liability and right of use assets. We want to look at a couple of examples as well of the transition accounting. So if I have an operating lease at transition, how do I account for that? If I have a existing capital lease at transition, how do I account for that? So we're going to start here with this operating lease illustration, and I'm going to walk through the workbook and show you the functionality so you can kind of see it in real time. So we'll go ahead and we'll create a new calculation worksheet. You're able to classify leases by accounting unit, and we'll show you the significance of that later. But if you have major divisions, lines of business, if you want to be able to group your leases in a certain way, you can select an accounting unit. But for this example, we're going to say that our lease commenced on 1/1/21, so a year prior to our adoption of ASC 842, that it was a 60-month lease with payments due at the beginning, and we'll assume a 3% interest rate for this example. Because this is an existing lease, we already know the classification. We don't necessarily have to enter the fair value and the remaining economic life at this time, because we're not going to use those for classification. We're going to use the ASC 840 classification as our initial, assuming that we adopt that practical expedient at transition. And so one of the considerations here is that Silas mentioned that for measurement, you only include those payments not yet made in the measurement of a liability, because if you've paid it, you don't owe it. And so we may say in this example that our next payment's not due until February. We already paid January 22's payment, maybe in December of 21. and we don't have to make our next payment until February. So we want to skip that January payment. We're able to do that by entering that date here as to when our next payment's actually due. So with that, because we've paid January already, we would have a prepaid balance on our books. But with it being an operating lease, and we're going to get to the payment schedule in a moment, there's non-level payments. So we're going to have a deferred rent balance also. We can plug both of those numbers in here as long as we apply the appropriate sign, debit or credit, that we have a prepaid and then a deferred rent for a net balance of $375. So for our payment schedule, we're going to assume that there's a fixed dollar increase in this. It's an easily determinable payment schedule where we owe $2,500 a month initially, but then it's going to go up by $125 each year beginning on the first anniversary date, which would be 1/1/22. We can influence all these variables by inputting whatever is relevant. And so you'll see here in our schedule, we've picked up this payment schedule where we're starting out at that $2,500 plus the $125, and then we increase each year. By doing that, we've now measured our remaining lease liability for this existing operating lease. And there's a small difference between the lease liability and the right of use asset because our lease liability is the present value of the future lease payments, whereas the right of use asset starts with that lease liability, and then we have to adjust for those existing 840 balances to get them off of the books. They become embedded into that right of use asset balance. And then you can see over here, we've got detailed journal entries by period where we would, at commencement or at adoption of 842, we would recognize the lease liability in its current and long-term portions, and we would remove the accrued rent from the books. One thing that we didn't do, and I skipped over this, but we'll see as I scroll through that we don't have a completely balanced entry, and we have a couple of integrity checks here. These allow you to identify whether all of your information was properly entered. And we did not go back and identify that this was an operating asset. We didn't specify that lease classification. As soon as we do, you can see that those integrity checks and cautions and diagnostics are resolved, and we have balancing journal entries. Taking a look at the capital lease at transition, we covered transition accounting a little bit in the previous session. And for capital leases, assuming that we've accounted for them correctly under ASC 840, those existing balances are going to be the starting point of our accounting under ASC 842. So I'll put in another illustration here. We'll start a new worksheet. We'll call this number 3. It's not number 3 because it's the third lease. It's just to illustrate the functionality again as we move through. But for this one, we'll say that it commenced on June 1st, 2019, that it was a 10-year lease, so 120 months. To change it up, we'll say our payments are due at the end of the period. We'll use a interest rate of 4.625. And here we'll enter a remaining economic life of 149 months. The remaining economic life can become more important for finance leases because depending on the classification, the reason that it's a finance lease, we may depreciate that asset either over the lease term or the remaining economic life of the asset. So there are some cautions and diagnostics built around that as well. But we'll go ahead and fill out this section of the table again that asks us for information about our next payment due date and balances existing under the prior standard because it's an existing lease. And on our books, we would have had a lease liability of $130,582. And there are a number of data validation controls built in so that if you enter something incorrectly, it will warn you and let you know what you need to do. So this says you have to enter it as a negative number. So I'll go back and correct that to a negative $130,582. And then I'll enter our capital lease balance from ASC 840. These would just come from your current accounting records. There's no math to figure these out because you would already have those balances. we'll go ahead and insert our payment schedule again. We're going to say this one has no escalation. It's the same amount throughout the entire lease term. But we have a purchase option that we're reasonably certain to exercise. And so that's the reason that we're classifying this as a capital lease. But we'll go ahead and assign that as our prior ASC 840 accounting. And then there's an additional option here when you have a capital lease. It asks you to identify why was it a capital lease. And again, that impacts how the asset is depreciated, either over the lease term or the useful life of the asset. And so now our lease liability and ROU asset schedules are populated, but we begin with these numbers that we entered up here. So it's going to start with those existing 840 balances. And there really is no initial journal entry because all we're doing is potentially reclassing them, or maybe we're just renaming the GL accounts. That'll vary by entity. But we're, instead of calling them capital leases, we're now going to be calling them finance leases. And again, this is an illustration of possibly the existence of a reclass or not. So Silas is now going to jump into kind of expanding on what he talked about and get into the concept of incentives.
All right, thank you, Greg. That was great. We did discuss about lease incentives as an element to calculate the right of use asset and lease liability. Let's look at lease incentives paid or payable at commencement. So these are lease incentives which would impact the calculation of the initial right of use asset and not the lease liability. So lease incentives could be provided by the lessor in various forms, including payments made to the lessee or on behalf of the lessee, right? Losses incurred by the lessor by assuming lessee's existing lease liabilities. It could be like an early termination penalty or something like that. Leasehold improvements, which is a common lease incentive. So in this table, so all of these incentives paid or payable at commencement would impact the right of use asset amount calculation. Again, here in this table, we have summarized different scenarios pertaining to leasehold improvements and the related accounting treatment for your reference. Again, we're not going to cover that in this presentation, but it is there for your reference. Next, we will look at lease incentives neither paid nor payable at commencement, right? So these are lease incentives which would impact the calculation of lease liability. For incentives which are paid or payable after lease commencement, there are two accounting approaches. If the incentive amount is known and it is highly probable that the lessee will incur the cost to be reimbursed, treat the incentive amount as a reduction to lease payments at commencement. Or if the amount is unknown, remeasurement is required when the amount becomes known, then reduce the lease liability and right of use asset by that amount and recognize the effect of lease incentive prospectively, or recognize the cumulative catch-up adjustment to lease expenses during the current period so that the periodic lease expense is recognized as if the incentive was receivable as of the commencement date. So there are two ways you can approach that accounting for incentives paid or neither paid nor payable at commencement. Okay, so now I think again, let's go through some illustrations, correct?
Sure, thank you. Yeah, we'll go ahead and set up one more illustration here to highlight a couple of concepts and features. So again, I'll click our button. I'll provide a name for the worksheet. And what this is doing, again, is copying a version of the calculation that is hidden and protected, so you're not able to unintentionally do anything to that protected worksheet. We'll provide it again, an accounting unit to separate. But in this example, we're going to look at the, how do we account for, how do we build in an incentive, assuming that we are reasonably certain that we're going to earn it, but it's not payable until a future date. So a common example might be a real estate lease where we get access to the location to do some build out prior to our actual opening. and then our lease payments will commence. So we're going to look at a 3-year lease. We'll say this one starts again after our adoption date. So this is not an existing lease. These existing lease terms then become grayed out and they're not relevant. We're saying it's a 3-month lease, but we're adding on that 2-month build out period because the lessor has given us access. We now have the right to use and control that space for those 2 months. Our payments will be due at the beginning of the period. We'll use a 4% discount rate. And we are going to go ahead and plug in our fair value of the underlying asset and economic life here. The fair value of the underlying asset often is difficult to determine, especially in real estate situations where you only lease a portion of the facility. So in the event that that's not known or determinable, you would not use that for classification. But we'll say that there's still, 30 years estimated on that facility. In this example, our payments are only due annually, so on June 1st of every year. And so none of these payment schedules, the automated payment schedules, don't really work in that circumstance because it's an irregular payment. So there's a manually enter payment schedule option that when you select that will provide you a column where you can actually go in and enter the payments due for each period. So we said that our payments are $100,000. They're due June 1st every year. So I'll enter those first. And you can see the schedule updates as I enter this information. But we also said that we get a $25,000 incentive, a reimbursement of our build out costs, an improvement allowance that, perhaps we didn't know at the very beginning how much we would actually spend, but then, after our build out period, we know what it is, we know that we've earned it. So those lease incentives are treated then as a reduction of your lease payments for calculating your lease liability. So I'm going to enter that as a reduction here in this cell so that we have a net payment of $75,000, which results in the calculation of the lease liability. We do have our right of use asset calculated because the initial calculation does not matter based on lease classification, but the subsequent accounting does. And we'll get more into subsequent accounting in a minute. But I do want to point out that if I come over and complete our classification table, in our examples, we provided that there is no transfer of title, there is no purchase option, it's not a specialized asset. So again, we look at our major part and substantially all tests, and clearly these are no in this circumstance. And so we have an operating lease where we would recognize down here in our journal entry the current and long-term portions of the lease liability as well as the calculated right of use asset. So we'll move to our first polling question.
Okay, here's our first poll. Have you identified resources to perform the implementation of ASC 842? And by resources, what we're getting at here really is personnel. So log your vote for one of the following. A, no, we only have a couple leases, which won't take much time. B, no, and we're concerned about capacity to do this ourselves. C, yes, we have a lease accounting rock star who will do this. Or D, my accountant/CPA will be happy to take care of this for us. And regardless really of where your organization falls among these choices, it's definitely important to plan ahead and make sure you have some resources identified. Okay, we will move on. Thank you, everyone. Okay, so this chart is a summary comparison of the balance sheet presentation of finance leases on the left versus operating leases on the right. And this is from the perspective of lessees. Starting in the top row for both types of leases, ROU assets and the lease liabilities are recorded on the balance sheet, with ROU assets presented as long-term, similar to PP&E, and lease liabilities presented in their short-term and long-term components, similar to that, as you saw in some of Greg's illustrations. In the next row, the only balance sheet difference between finance and operating leases has to do with how the ROU asset is amortized or decreased over time. For a finance lease, the ROU asset is amortized on a straight line basis. However, for an operating lease, the ROU asset is treated a little differently. It is decreased by an amount that, when combined with the interest accretion on the lease liability, it will result in a straight line lease expense. We'll demonstrate this with an example coming up soon. Moving on to the third row, ROU assets are subject to potential impairment. We'll talk about this more. In the fourth row, we have the lease liability. Over time, it will increase due to accretion of interest, and it will decrease as lease payments are applied. Lastly, our chart concludes pointing out that ROU assets and lease liabilities might require future adjustment based on certain circumstances in the future. More to come on this as well. Okay, now we have a chart that compares the income statement treatment of finance versus operating leases. In the top row, for a finance lease, total expense will decrease over the lease term. That's because the lease expense is comprised of two parts. One, the straight line amortization expense for the ROU asset. This element is constant. And two, interest expense on the lease liability. This element will decrease over time. On the right side, for an operating lease, total expense will remain constant over the term. The underlying computation of lease expense still has two parts, decreasing the ROU asset and recognizing interest on the lease liability. However, the reduction of the ROU asset will be plugged to result in straight line expense. We have some numbers on the next slide to demonstrate this. But for now, moving on to the second row, in the finance category, expense is reflected in the P&L as two distinct parts, amortization expense and interest expense. For operating leases, expense is recorded in just one single line item, operating lease expense. And moving down this chart, both finance and operating leases may reflect variable lease expenses, depending on how certain lease payments are designed. And again, for them to, the P&L may be impacted by certain future events. Okay, so here's a table with some numbers. I hope it's not too much of an eye chart, but we set up a hypothetical lease that is computed in this table as both finance and operating leases for comparison. The columns shaded in dark orange are the ones that contain amounts that would be recorded in the financial statements. The first two columns on the left show that cash payments and lease liability balances are the same for both finance and operating leases. Total expense of $500,000 over the lease term is the same for both types of leases. And notice that the amortization and interest expense totals in the finance lease section add up to $500,000. So although expense totals are the same, the timing and the presentation of the expenses will differ. In the finance lease section, amortization of the ROU asset is constant throughout. Interest expense, using the effective interest method, is higher in the early periods and lower in the later periods. As the sum of these two parts, then, total expense for finance leases will decrease over time. In the operating lease section, straight line lease expense is computed by allocating the $500,000 of total expense straight line over the lease term. The ROU asset reduction, or the plug, each period is calculated as the difference between the straight line lease expense and the interest accretion in the column next to it. One more thing to point out, using differences presented in the far right column of this table, is that ROU asset values are higher for operating leases than their finance lease counterparts. These higher values will cause operating leases, their assets, to be more prone to potential impairments in the future. Greg has some examples and amortization tables to share.
Sure, we'll just take another quick look back into the lessee ledger tool to illustrate those concepts. So um, looking back at our illustration number one, this was a finance lease. And so when we look at the amortization of the right of use asset over the lease term, you can see that that amortization is straight line. It's $482 every month, every period. But the liability, the accretion of interest on the liability, as you would expect, goes down as the liability goes down. So our total expense decreases over time. Compared to what we input as an operating lease, our right of use asset amortization actually increases, as Cheryl mentioned. That way, when we add it with the accretion of interest, we get a straight line expense number throughout the lease term. And you can see that pretty clearly here in the third year. After we've made all of our payments, we don't have any liability left, so there is no interest, but we continue to amortize that right of use asset. You can clearly see then that that amortization is equal to our expense for that period. We can also show you through journal entry activity. So when we refresh our index tab, it updates for all those illustrations that we just entered, and we can control the information that we look at through the various red input cells. So this date would influence our journal entries, for example. Right now we're looking at that first month, and when I assigned accounting units, this just illustrates how you can view journal entries for a group of leases separately. But you're able to see that we put on our initial right of use asset balances and our liabilities. And then for subsequent accounting, if we wanted to move into the next month, we simply change the date here and it'll update all the information for us so that when we go in and look at journal entries, we have just the activity for that period that we can post and move forward. So Cheryl, you want to talk about variable lease payments?
Absolutely. Okay, so variable lease payments are essentially broken down into two categories. Those that vary in the future based on an index or rate, and those that vary based on anything else. For payments based on an index or rate, they are included in the measurement of the lease liability based on the index or rate that's in effect as of the measurement date. How you account for future changes in the index or rate depends on whether the variability in that rate is resolved. So if you have a contract that specifies that lease payments will simply adjust based on a benchmark rate, variability won't be resolved during the lease term. And in this case, the lease liability would not be remeasured in future periods of the lease. However, let's say you have a contract that specifies that lease payments will adjust with changes in a benchmark rate, but subject to a cap of 3% or something like that. If and when that 3% increase is met, all future payments in the lease would effectively become fixed, and this would trigger the need to remeasure the lease liability. As for variable lease payments that are not based on an index or rate, for example, rent payments that are based on tenant sales, or lease payments for a truck based on miles driven, they are not included in the initial measurement of the lease liability, and they would not trigger the need to remeasure the lease liability until or unless they would meet some condition that effectively fixes those payments. Greg has some examples incorporating variable lease payments.
Sure, so we'll just take a look at one here. We're going to do a continuation of our illustration number 3, where we had a hypothetical lease of machinery. But now we're going to assume that we're adding in a requirement to pay some annual maintenance fees. And they're going to be based on hours of usage, so that's not based on an index or rate. That is something that remains variable until we get to a point at which we know those annual hours of usage, and we can determine what that maintenance fee is going to be. Going back to a concept from the first session of the practical expedient, this lessee is not separating lease and non-lease components. Therefore, the maintenance is considered part of the lease component, the combined component, and is reported as lease expense, not maintenance expense. So how do we account for that? How do we track it? It's the amount that we're going to owe that first year is not included in our scheduled rent payments. So we need a way to include that information in our calculations. And Lessee Ledger provides a variable lease payment column so that when your actual payments differ from your scheduled payments, you're able to enter that in and calculate that information. So we'll say here at the end of the first year, we know that we now owe $700 of maintenance fees because we use the equipment so much. Our total payment was $2,200. This is going to determine that that $700 excess is a variable lease expense, and we'll include that in our journal entry as variable lease expense. So that's an important functionality of whether you develop something or look for a solution, that you're able to continue your accounting after the initial measurement, that it's an ongoing process. Oop, I went one too far. Cheryl? Cheryl, you're muted.
Muted.
Thank you. Okay. So now we'll talk about, after initial measurement of your lease liability, there could be changes in the future. There could be contractual changes, excuse me, to the terms of a lease agreement. And if those contractual changes were to alter the scope of or consideration for a lease, they are called modifications. Separate from that, there may be changes in assumptions or circumstances related to a lease. For example, a change as to whether it's reasonably certain that a renewal option will be exercised. And if changes impact certain aspects of your lease, they are called remeasurement events. Both modifications and remeasurement events will trigger the need to remeasure, which means recalculate your lease liability. And there will be a corresponding adjustment to the ROU asset as well. There's more information here that you can refer to later as needed, but we want to focus this webinar on adoption and initial measurements, what we're calling day one accounting. So we won't dive into detail on these rules other than just to mention that the occurrence of certain events will require remeasurement of lease liabilities and adjustments to ROU assets. And monitoring these events will be important for day two accounting that organizations will want to plan for. So we have another slide relating to modifications and remeasurements. Depending on the circumstances, other steps aside from recalculating the lease liability and adjusting the ROU asset may also be required, such as reassessing classification, reallocating contract consideration to components, etc. So Greg, we'll go to you for an example of remeasurements.
Okay, so we're going to revisit another illustration here where we had our 3-year real estate lease. And again, this illustrates that the ongoing accounting can be complex. And so there are a lot of nuances with the modifications and remeasurements, but we've built in some functionality here that if you indicate that there is a remeasurement event, we're going to get a number of additional input fields that we can start updating. So in our example, we get to the end of the second year, at the end of 2024, we say, you know what, we're going to be here a little longer. We have a renewal option that we didn't think that we were going to exercise initially, but now we've changed our mind and we are going to renew. So we didn't include it in our initial lease term and liability, but now we need to update. So we're going to add those additional 24 months. And there's no other input because we'll come down to, I apologize. This is, you can simply change it to no if you want to hide your information. But I wanted to come over to illustration 4 for this. So let me catch up real quick. We're adding 24 months. These terms aren't relevant to this particular lease, but if you were changing your purchase option, termination penalty, residual value guarantee, you could update those there. We are going to reassess lease classification over here for a number of items. In this case, we still know there's no purchase option, but then clearly based on where we were at in the beginning, and we're only adding 2 more, I don't need to update our current remaining economic life and fair value, But if there was a question as to whether that would change your classification, you certainly can enter that as of the remeasurement date. And then when we do that, we're going to get a highlighted remeasurement period here at 12/31/2024. And I just need to enter the additional payments because it's manual. If this was not a manual payment schedule, it would automatically update for you. But I can enter in those 2 additional annual payments. And you'll see that at 12/31/2024, we add the liability. We went from 0 because we had paid it all down. And then we also increase our right of use asset for that additional term. And you will see in your journal entries that that's accounted for, that we're increasing our liability and increasing our right of use asset. So the ability to remeasure calculations quickly and easily is important because that can become complex. Cheryl?
All right. Moving on to the short-term exception. So if an organization has elected the short-term exception and does not apply ASC 842 to leases that have initial terms of 12 months or less, there are times that excluded leases should be reassessed. This would arise if the lease term changes, for example, through the execution of a renewal option, which would lengthen the term, or if the lessee becomes reasonably certain to exercise its option to purchase the leased asset. In these cases, the lessee would apply the classification and measurement guidance and include these leases in its ASC 842 portfolio. We'll move on to the next slide on asset impairment. So ROU assets are subject to the same guidance about potential impairments as regular PP&E. If a finance ROU asset is impaired, the lessee will revise future amortization expense by calculating a new straight-line amortization schedule for the asset using that lower impaired value. So lease expense would decrease after impairment. If an operating ROU asset is impaired, the future total amount of lease expense will no longer be recorded on a straight-line basis. Instead of the ROU asset being reduced by the plug, which normally causes overall lease expense to be recognized straight line, the ROU amortization piece will now be straight lined itself. And when combined with the interest expense on the lease liability, operating lease expense now will decline over the remainder of the lease, behaving very similar to finance expense. So Greg, back over to you for another example.
Sure, and the impairment is actually a very quick example. In the model here, there's only 2 inputs. So we're going to use an impairment date of 12/31/2024. And when I put that in, it automatically indicates here what my loss would be if I had no value at that impairment date. But I'm going to put in $12,000 here. It makes for a clean illustration that you'll see in a second. But with those 2 inputs, I've calculated an impairment loss of $20,000. And coming down to the amortization schedule here, it highlights when that impairment occurred. You can see there's no change to the liability. It's only a reduction of the ROU asset down to that impaired value at that period. But the change here is that we go from straight line expense on an operating lease to, after impairment, we have straight line amortization of the right of use asset. So our expense is no longer on a straight line basis. So again, that's just one of those complexities of preparing the calculation and being able to adjust for that change in the pattern of amortization. Cheryl?
Okay, now on to lease termination. So instead of running the normal course, leases may be terminated at some point. Termination could occur for a lease in its entirety or just partially. For example, reducing square footage in a facility that is leased, or decreasing the number of vehicles in a leased fleet. Or perhaps the leased asset is purchased by the lessee during the lease term. Again, as these are day 2 accounting concerns, we won't dive in further now, but wanted to provide this information so that you can consult it post-adoption if needed. And with that, we will move on to polling question number 2. Have you discussed the impacts of ASC 842 with users of your financial statements? A, no, not yet. I'm still trying to figure out what they are. B, at a high level, but the users are not concerned. C, yes, but we're still figuring it all out. Or D, yes, and we have to make adjustments to related agreements. We hope that our training sessions are tools that are helpful to anyone who is answering with item A. Okay, thank you everyone for your answers to that polling question. We'll move on.
Thank you, Cheryl. Looks like we have another 15 minutes, and quite a bit to cover. So let's keep going. So let's look at lessee's presentation and disclosure. Lessees could adopt a policy election to either present the right of use asset and related lease liability as separate line items on the face of the balance sheet, or to disclose the details in the notes to financial statements. Please note, we cannot combine the finance leases and operating leases either in the balance sheet or in the notes to financial statement. They need to be presented separately. If it is disclosed in the notes to financial statements instead of on the face of the balance sheet, we need to disclose which line items in the balance sheet include the right of use asset and lease liability. Like Cheryl said previously, generally, right of use asset would be classified as non-current, and lease liability could have both current and non-current presentation. Let's look at lessee's accounting in the statement of cash flows. So for finance lease, payments of principal amount will be classified within financing activities, and interest portion of the lease payment will be classified within operating activities. For operating leases, lease payments, lease liability payments will be classified within operating activities. As you can see in the slide, the presentation for variable payments and short-term lease payments are the same for both type of leases. Impairments and effect of remeasurement or modification are non-cash activities for both type of leases again. For operating leases, any capital cost incurred will be classified within investing activities. Now let's look at the disclosure requirements in the notes to financial statements. Both qualitative disclosures and quantitative disclosures are required. Again, in the interest of time, I'm not going to go through all the items listed here. However, you can see the qualitative disclosures required is extensive under ASC 842 compared to ASC 840. The disclosures require policy election disclosures and transition disclosures, in addition to many other disclosures. Again, we have put all this information on the slide so that it can be a reference for you at a later date. The next, the next is the quantitative disclosures. Again, in the interest of time, I'm not going to read out all the items listed here. However, similar to the qualitative disclosures, extensive additional quantitative disclosures are required under ASC 842 compared to 840. Great, let's go to the next slide. So here we just wanted to give illustration of the quantitative disclosures. You can see all the disclosures we have to provide it separately for finance lease and for operating leases, right? And then also included in the disclosures are like weighted average, remaining lease term, discount rates, etc., which obviously was not there under ASC 840. So we just wanted to show it again. I don't think it's readable, but at least it's a reference so that you can see the nature and type and the extent of disclosures that's required under ASC 842. Let's go to the next. Okay, so again, continuing with the quantitative disclosures, you can see the line items again for finance lease and operating lease. Also, it includes disclosures, additional disclosures for 842, and separate for finance lease and operating lease. That's a common theme. You cannot combine the presentation. either in the face of the balance sheet or even the notes to the financial statements. All right, next, Greg will show some lessee ledger examples, right?
Yeah, so we want to just show how a compliance solution can help summarize that information for disclosure, as well as a couple other areas that you should be thinking about. When we go back again, we'll change our date here. We want to move forward and we'll look at the disclosure information for the end of that first year of adoption. And when I change that date and come to our disclosure tab, you're able to see that we have this initial impact of adoption from the leases that we entered, primarily the recognition of that operating lease that existed, and the removal of those 840 balances for prepaid or deferred rents. And then we have a breakout of the other disclosure information between operating and finance leases throughout, including cash flow information, the related asset and liabilities for both operating and finance. And a couple that are new and a little bit unique are the weighted average remaining lease term and the weighted average discount rate. So you have to combine information from all of your leases to be able to calculate based on the remaining discounted and undiscounted payments. What are those weighted averages to report? Again, separate for finance and operating, and then our future maturity schedule. We'll take a look at one more. We'll go back and we'll update. We'll move forward a couple of years. When we go to 2024, that initial impact is now no longer relevant. We only report that in the first year, so that information goes away. But now you can see some other activity, such as the impairment that we recognized in a prior example. And again, a continuation of all of the other disclosure information that you need for that accounting period. If you happen to be doing quarterly financial statements, you could change the number of months. That's going to update your primarily the lease cost information for that period, but you are able to affect how much of a period you're looking at. We also have information to help you with tax calculations and adjustments. This was sort of one of the lessons learned from early adopters, that they didn't realize how hard it would be to get the tax information back out of their ASC 842 balances, because they used to be separate general ledger accounts, and now they're included and baked into that right of use asset balance. So making sure that you're able to get that information quickly is important. And then a roll forward schedule. This allows you to look at the activity both by lease and in total for all leases. This is something that your auditors are likely to ask for or want to see, but it also really helps internally with a reasonableness check on activity. And again, you can influence, the amount of time that you're looking at within this schedule. And we can see the effect of our remeasurement that we recognized in December of 24 in a prior example. So with that, we want to move to our last polling question, kind of quick back to back here, but
Okay, here's our question. How do you plan to prepare and maintain lease accounting calculations? A, internally developed spreadsheets. B, I'm interested in Sikich's lessee ledger. C, I'm looking at a variety of other third-party applications. D, we already selected a third-party application.
for anybody who was on the first session, this question might seem very familiar.
Okay, we'll wait for the results. We'll announce these results for Greg's benefit. Okay, Greg, we have some preliminary results here. We have 28% for internally developed spreadsheets. We have 62% interested in lessee ledger, 6% looking at a variety of other options, and 4% already selected a third-party option. So we'll hand it over to you.
Okay. So 28% is down a little bit compared to where we were last webinar. Just over a third, or about a third of attendees in the prior webinar plan to do it internally. And so I don't know if after that webinar, or maybe with what we've shown you today, it's evident that there's a little bit more that goes into these calculations and maintaining them over time with the subsequent accounting requirements. They do become complex, and then accumulating all the information that you need. So even with the 28%, it's not unexpected. We know that there are a lot of businesses that are going to choose to try to perform these calculations, especially if you have, just a couple. But we do want to at least, help you think about what's going to be required over time to prepare and maintain those. There's a lot that goes into this, and so the investment in a solution may very well be worth it and offset some of the other issues and pains and troubles that you would encounter in the future from relearning the standard when you do have to update it, or if you have turnover in whoever your accounting rock star is on leases. So we're happy to discuss that with you further. But we do want to put that out there, that's something that we really encourage you to think about over the next few months prior to adoption, if that's your decision. Does that make sense over the long term? Also, as a reminder, this implementation process is very time consuming. Again, that's one of the biggest lessons learned from from the public company adoptions and other early implementers, is that it just takes more time. From understanding the standard, setting your policy elections, going out and finding all of your contracts. We talked about embedded leases in the prior session. Those aren't clearly evident that they exist, and it's a new consideration. Collecting all of your data, picking how you're going to perform your calculations and maintain them, actually executing those calculations and preparing your financial disclosures, and then just maintaining that for as long as any of us know. There's no end to this. So it's not just do the calculations at the adoption of the new standard and move on. This is going to be an ongoing accounting requirement. We also wanted to remind you of the implementation toolkit. We covered a number of these items in the prior session, and so if you didn't get a chance to see them, feel free to rewatch that session or visit the links provided here. But we have insights that talk about specific topics. We have a roughly 30-page handbook that gives a really good base understanding of the standard and includes a policy election template at the end of it to help you with that. A data collection tool, which will help you organize the contract data to abstract your contracts and prepare your data either for import, if the solution that you pick allows for import, or just organize data input into a spreadsheet tool. The implicit rate calculator. We do have a software selection tool, which is just really a worksheet to help you think about that selection process. What criteria do you have as an entity? What is important to your company for the ongoing accounting? And are there certain features that you need? Do you just need a lease accounting solution, or do you need a lease administration that will help you with critical date notifications and those sorts of things? So there are a number of solutions out there that range in feature set and price. And again, we're happy to discuss that with you. We have a familiarity with a number of them. And then, as we've shown you, we have the Lessee Ledger, which is an Excel-based solution. Being in Excel, it's familiar, it's on premise, it's it looks like a lot of data inputs, but they're all there right in front of you instead of having to step through input wizards or other things to enter all those terms. And that will be available to you for a one-time perpetual license fee. So you pay it once up front, and then regardless of what you do with it in the future, how many new leases you enter into, there's never an additional cost. And we've really structured that to be competitive with the first 1 or 2 years that you would pay any other cloud-based ongoing subscription. And so I think when you look at those, you'll see that this is really an affordable solution. We're proud of it. We've invested heavily in it, and I think you can see from the illustrations that it's able to handle a lot of inputs and complexity in the calculations, so that it is able to do nearly all calculations that you would need. So what should you be doing now? If you haven't started these things, we just wanted to highlight a few things that you should be thinking about for the next couple of months, getting ready for the effective date. Making those policy elections, that's going to guide how you transition and adopt the standard. Identify your contracts, collect the data, figure out how you're going to perform the calculations. Think about any new accounting processes that you're going to have to develop and train on, whether you will need new general ledger accounts for operating lease right-of-use assets and operating lease liabilities. Consider impacts on your ratios, your debt covenants, other financial measures. How is this going to impact your financial statements and the users of your financial statements, including that comparability in the first year? Have those discussions with your users early so that there are no surprises or concerns later on. And then also for those agreements, especially those related party leases, we talked about related party leases a bit in the first session, where there aren't formally documented terms, you may want to go ahead and do that so that it removes the ambiguity of adopting the standard later so that you know what those terms and conditions are. And so with that, we want to wrap up and thank you. As we mentioned, we did not have time for questions, but any questions you submitted during the session or in the post-session survey, we will take a look at those and respond individually. And we should be able to get those back to you quickly. So please submit any questions that you do have and we will get back to you. But thank you for your time. We appreciate it. If you answered the poll questions and complete the survey, you should receive your CP certificate within about 2 weeks. So thank you again.
Thank you all.
Thank you.